So you're looking to buy an investment property. And sure, maybe you've bought your primary before, maybe even bought a second home, but this property is exclusively for cash flow and rental. Well, today I'm gonna tell you the cost structure and the setup is slightly different than what you were accustomed to when you bought either your first home or even a second home. My name's Aaron Benton, I'm host of this channel. I live here in Bluffton, South Carolina. Tons of short-term rental, long-term rentals between Bluffton, South Carolina and Hilton Head, South Carolina, located here right on the Atlantic Ocean. So no stranger to conventional financing when it comes to investment properties or even a DSCR loan. Stick around because today we're going to talk about the fee structure and different strategies surrounding investment properties. So stick around so you're not caught off guard when you go to purchase your first investment property. So the first topic is interest rate. That's a big difference. So if you were to purchase your primary home, you put down 20% and you had your rate. Well, I'm here to tell you that the minute you are buying a property as an investment where the roof is not the one over your head, the interest rate is going to be higher. And sometimes that's 0.25%, sometimes that's 1.5%. This is credit score driven. This is down payment driven. Of course, the more skin in the game, the larger the down payment, then yes, the interest rate is going to be more favorable because you've put more of your equity into the property. But nevertheless, understand that if you bought your primary, you put down 20%, the interest rate on an investment home is going to be higher. Where did that all come from? Well, think back to 2008 when the first homes that people walked away from were their non-primary residence, not the roof over their head. Those were the first foreclosures or deed in lieu of foreclosures, short sales, things of that nature. People walked away on their investment properties. So Fannie Mae and Freddie Mac, the government arm that securitizes mortgages, they're willing to help you invest in real estate and invest in these investment properties, but it comes with a little bit of a price tag, a higher interest rate. So how do you offset that? A little bit more skin in the game. Now, if you're utilizing a DSCR loan, a DSCR loan is a loan that is for investment purposes only and it's business driven. So you don't have to income qualify. When you're buying a conventional loan, many times you have to have a job. You have to have a job that's going to support not only the debt that you currently possess, but also some of the debt that this house might have. Now, understand if you're buying it as an investment, there is what's called an appraisal, and the appraiser goes out and gets a rent schedule. And that rent schedule will project out what the property can rent for. And from a loan qualification standpoint, we are able to use those rental projections or potentially rental history if it is currently being leased as income, if you will, to offset the cost of that investment. So when you're buying an investment property, the appraisal and the rent schedule in particular is very, very powerful. A DSCR loan, I say many times, it's the easiest loan to start. Why? Because you don't need to have a job, you don't need to income qualify. Rather, on a DSCR loan, it is all based on how much the property how much it costs versus how much does the cash flow, how much does it bring in? And there are different scales. Sometimes you want it 1-to-1. It costs you the same amount as the rent. Other times the cost could be a little bit more. Now that's going to reflect a little bit higher interest rate. And other times, of course, then the rent is going to be better than the cost to carry, and that can improve your interest rate. So the appraisal plays a very, very large role. So first you have your down payment and understand that you got your interest rate, and those are some of the upfront costs. But back to rate. Conventional financing, that you don't have these what's called prepayment penalties. Many times I get a question, well, if I pay this loan off early, is there going to be a prepayment penalty? Do I have to pay a fee? The answer to that is no. On a conventional loan, that is illegal. However, if you go into the world of DSCR, you're going to see anywhere from no prepayment all the way up to a 5-year prepayment. So you can imagine the longer the prepayment penalty time, the lower the interest rate. If you're going to sign up for a 5-year prepayment penalty, meaning you cannot pay this loan off in 5 years, you know that the investor is going to get their money. They're going to collect interest on you for 5 years, and as a result, the interest rate is going to be lower and potentially most likely more in line with that of a conventional loan. Now, if you get a DSCR loan, and you have no prepayment penalty, then the interest rate, of course, is going to be higher. Look for that interest rate to be about 1 to 1.5% greater than that of a conventional loan. And the whole reason we're talking about interest rate here is it's a product of risk. The riskier the file, the higher the interest rate would be. You can imagine with a DSCR loan, since you're not income qualifying, yes, the rate's going to be a little bit higher. With a conventional loan, the rates will be lower because you've gone through the income qualification piece and basically proved, hey, I have a job that can support this property. And yes, there's more rigorous documentation and such, but the benefit of that is a conventional loan. Whenever I talk to somebody who wants to get into investment properties, we start with a conventional approach first because it's the most advantageous to you as the client. Best interest rate. Now, if that doesn't work, of course, we can then shift to a DSCR loan. The next topic is reserves. So when you buy a primary residence, you do not need to have reserves, or sometimes the automated system says you need a couple months of reserves, but many times you don't need any reserves in order to buy the property as a primary residence. The minute you get into an investment property, you're going to need some reserves. Now, again, it's driven by the automated underwriting system, but on a conventional loan, you should expect to see you need 6 months worth of reserves, and on a DSCR loan, you can see as low as 2 months as reserves. So what happens, what is a reserve? It's monthly principal and interest, taxes, insurance, and then the HOA fee if one exists. You take that total number, you multiply it by the number of months, and that's the total amount of money that you have to have in reserves or in the bank. Now understand, that money does not need to be liquid, so don't think that you gotta drain your retirement account. It can be sitting in IRAs or 401ks or investments. It doesn't need to be readily liquid. You don't need to do a fire sale of your portfolio, but it does need to be there. So reserves on an investment property, very, very prevalent. The next topic would be closing costs. Now, in a previous video I mentioned you're going to get an appraisal, and on an investment property the appraisal is going to be a little bit more because you got to get a rent schedule. And not only is the appraiser valuing how much the house is worth compared to what you're paying for it, buying it for, but they're also looking at the rent projections. So you're going to see an appraisal be a little bit more. You're also going to pay your normal mortgage related costs, your attorney related costs if you're in South Carolina. Again, different states have different, you're either an attorney state or a title state, and depending on the state, you're going to see different fee structures. My company, to get you from start to finish, charges $17.50. That is the origination application processing fee is $17.50. Then you're going to have your attorney. They're going to charge you anywhere from $17.50 all the way up to $2,500 to get you from start to finish, plus the title insurance, plus that first year of insurance, a homeowner's insurance. That is, if you're in a flood zone, you're going to need a first year of that as well. You will escrow tax and insurance money. Again, your money, should you sell the property, whatever money is in your escrow account will come back to you. Then you might have neighborhood transfer fees. So those fees, much in line with that of a primary purchase, you're just going to notice that the appraisal was a little bit more because of the rent schedule. People also look at discount points when they're buying investment properties. Why? Because investment properties, people like to see cash flow. So discount points, pay me now, meaning pay the bank up front for a lower than market interest rate. And the reason they're doing that is they're willing to front some upfront cash in exchange for a lower interest rate, which will result in a lower monthly payment, and in turn, that will help the property cash flow on a monthly basis. It's just a way of thinking or a train of thought. You don't have to utilize discount points, but if you're looking to kind of maximize your monthly return, it is a strategy or something that individuals look at. I see myself on investment properties utilizing discount points more often than that of, say, your primary residence. Again, I think it all comes back to cash flow. So discount points, very powerful tool. As you can probably tell through this whole investment property purchase, there are a lot of people involved. You got your real estate agent, your mortgage lender, your attorney, an inspector, an appraisal, potentially the HOA management company. So there's a lot of people involved in this transaction. They're all taking a little bit of the cut, which in turn is going to be your upfront costs or closing costs. And as you know, this is just a little bit more than that of a primary purchase, the appraisal being the number one factor. But understand, on investment property, you need more skin in the game. You need a greater down payment. The interest rate's going to be a little bit higher, but in exchange for that, you're building wealth. I personally own an investment property and it cash flows very positively for me. I also get to utilize that on my Schedule E. Reach out to your accountant or your tax preparer, as owning real estate is very beneficial to you from a tax perspective piece. I'm not licensed to talk to you about it, but it's worth reaching out to your advisor on that topic. My name's Aaron Benton. I hope you really enjoyed the video. I ask, subscribe below, tap the bell for notifications, like the video, let your friends know about me. It's one of these topics where I'm here locally in Bluffton, Hilton Head, South Carolina. I understand the rental markets, and I would love to understand your situation. So I did include my calendar link below. If you want to book a call with me, set up a Zoom meeting, click on that, fill it out. I'd love to connect with you, but if not, I'd at least like to see you on the next video.